These are the 5 golden rules of investing if you want to master the stock market, from the spoken words of the greatest investor of all time.
5 or 6 years later, bought the place when it was doing $3 million a year, now does $300 million a year.
Recordings that you might not have seen before, and from his brand new shareholder letter filled with advice for the average investor. If you're investing in stocks, these are the 5 principles that you must know for achieving long-term success. And at the end of the video, I'm going to reveal Buffett's not-so-secret weapon that you can use to supercharge your results. And if there's ever been a time to learn from Warren Buffett, it's right now, the week of the Berkshire Hathaway annual shareholder meeting. For the 3rd year in a row, Brandon from New Money and I have travelled all the way from Australia to attend the meeting in Omaha, to meet some of the most passionate investors in the world, some of you who are watching the video right now, and to curate the lessons learned from Buffett's Q&A sessions into videos for you, none of which would be possible without the help of Morning Brew, our sponsor for this year's trip. Morning Brew is a completely free daily newsletter for busy people and busy professionals. They condense the most important business news into quick, witty stories that make it easy and enjoyable for anyone to stay informed. The newsletter is delivered to your inbox every morning, and I've been using it to discover current events that I might want to discuss in my videos. Like this story from one of last week's newsletters about the rise of serial streaming service churners. I was fascinated to learn that about 40% of subscription cancellations came from people who regularly chop and change services. And again, it's completely free. There's already more than 4 million professionals reading Morning Brew. It takes 10 seconds to sign up, so there's absolutely no reason not to try it. Sign up for Morning Brew today by clicking the link in the description or heading directly to morningbrewdaily.com/Hamish. In 2013, Warren Buffett made one of the worst investments in his entire life. In partnership with 3G Capital Management, his company Berkshire Hathaway bought the food giant called Heinz, which went on to merge with Kraft to form an even bigger food empire. But since then, its stock price is down significantly.
It's a very valuable business, but we paid too much for Kraft, and we...
Interestingly, despite Buffett admitting the investment was a mistake, he did something that saved himself from a complete disaster. In the 2013 acquisition, he was also buying $8 billion of preferred stock in Heinz that paid a fixed dividend of 9% every year. The condition of this deal prevented Berkshire from suffering permanent loss of capital.
We have an extreme aversion to incurring any permanent loss with your funds.
All investments have some level of risk, but you want to avoid situations where you could lose some or all of your initial investment. In this year's shareholder letter, Buffett writes, "Our investment rule at Berkshire has not and will not change. Never risk permanent loss of capital," a rule that Buffett has used for over 6 decades. In the 1962 partnership letter, he wrote, "I cannot promise results to partners. What I can and do promise is that we will attempt to bring risk of permanent capital loss to an absolute minimum by obtaining a wide margin of safety. By only investing in stocks where their price is far below its value, you prevent permanent loss of capital related to your incorrect estimation of what the business is actually worth. The arena in which we operate has been and will be rewarding if you make a couple of good decisions during a lifetime and avoid serious mistakes." What he's saying is that preserving your capital in the inevitable mistakes that you will make over your lifetime is equally as important as picking the occasional winner. But this isn't just about the price you pay for a stock. Permanent loss of capital also arises when you invest in not so great businesses whose value actually declines over time. So Buffett's second rule is to only invest in wonderful businesses. In 2001, a man named Craig Ponzio asked Buffett to buy his business. He ran a custom framing business in a very, very competitive industry.
Well, with 18,000 people in that business.
But in spite of intense competition, Ponzio grew the company into a giant.
5 or 6 years later, bought the place when it was doing $3 million a year, now does $300 million a year, and it totally dominates the wooden custom frame business.
Ponzio's framing business thrived for many years because it met the characteristics of a wonderful business. Our goal at Berkshire is simple. We want to own either all or a portion of businesses that enjoy good economics that are fundamental and enduring. The business must be able to generate high returns on the capital it deploys, which usually means it can produce more profit than other businesses on roughly the same physical assets, setting prices higher or maintaining lower operating costs than competitors.
And it has 22 plants around the country that can get the frame that the custom framer orders 85% of the time. If they order it by 5 o'clock today, they'll have it by 3 o'clock tomorrow afternoon. That's what the customer wants. They don't care whether they pay $83 or $88 to get the thing framed. You've got something you want done, and you want it done fast. And that little custom framer, those 18,000 people, they want happy customers, and that means speed of delivery and certainty and all that.
But it's not just about having a superior product or service. There needs to be something protecting those economics over time. What's stopping other framing companies from matching their fast order turnaround time and eliminating their advantage?
You couldn't build a distribution system to compete with us. I mean, just think of trying to build a distribution system starting from scratch that would take that business away from us. It can't be done.
Other framing companies didn't have the network of warehouses all across the country. It was physically impossible for them to match Ponzio on the speed of his delivery.
Every time I buy a business, I say to myself, if I had $1 billion and I wanted to go in and compete with these guys, could I knock them off?
The company Ponzio built is called Albeca, and Berkshire Hathaway acquired them in 2001. But most importantly, to this day, Buffett still owns it. When you find a truly wonderful business, stick with it. Patience pays. One wonderful business can offset many mediocre decisions that are inevitable. The trick is to hold on to these sorts of companies because their true value reveals itself as it compounds over multiple decades. Okay, let's shift gears for a second. Let's talk about Tesla. I know this video is about value investing, but just stick with me for a moment. Since 2019, its stock has returned over 800%. And back in 2019, I actually spent a good deal of time looking at it as an investment. In the end, I chose not to invest in Tesla. And to the uninformed, this might sound like I'm describing a mistake, but I'm actually describing a very, very good decision because I knew absolutely nothing about the auto industry. This skill is called knowing your circle of competence. What are the things that you know extremely well? And more importantly, what are the things that you don't know well?
Is there anything in that box? And can you tell what's in that box and what isn't in that box?
As simple as this might sound, violating this investing rule is the source of most bad decisions. To be a great investor, you need to stick to your advantages. Charlie Munger once said, "I don't want to play a game where people have an advantage over me. I look for a game where I am wise and they are stupid." And determining whether a stock is in your circle of competence is actually really easy.
I would say this, if you have doubts about something being in your circle of competence, it isn't.
The boundaries of your competence should be pretty much self-evident, because again, in the wise words of Charlie Munger, it wouldn't be much of a competency if you didn't know where it ends. The next rule is the hardest one to follow. It's the one where Buffett admits that he's made the most mistakes. We also hope these favored businesses are run by able and trustworthy managers, though that is a more difficult judgment to make. An investment in a stock puts your money in the hand of a group of executives with enormous power. Power that controls how capital is allocated in the business and how information is communicated to the shareholders. So they must have two important traits: skill and integrity. Assessing those traits in management teams is extremely difficult, but there are some tricks.
When we read things where we basically are getting dishonest messages from the management, it makes a difference to us.
Look at the management's track record. Do they actually deliver on the promises that they make over time? And when times are tough, how are they communicating that to the shareholders? You're often not really looking to find honesty, but rather find dishonesty that helps you avoid jumping on a sinking ship. Congrats on making it this far in the video. You're about to learn Buffett's not-so-secret weapon for beating the market over many years. But first, let's talk about the most fundamental piece of Buffett's investing strategy: birds. No, not those birds.
A bird in the hand is worth two in the bush.
It's a somewhat strange analogy, but it perfectly describes the only reason you would ever make an investment in the first place.
The only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
When you buy a stock, you're buying a claim on the future profits of the business. Regardless of what you pay, the business will go on to produce a particular amount of profit. So the variable that you're in control of is how much you pay today for those future profits. Well, what I mean to say is you control your decision to buy or not. The market, of course, sets the price, and most of the time, the price is too high. And this is where Buffett's not-so-secret weapon comes out. Occasionally, markets and/or the economy will cause stocks and bonds of some large and fundamentally good businesses to be strongly mispriced. 2022, 2020, 2008, 2000, all of these are times where stocks have been broadly pulled down by a shift in market sentiment. The common theme with all of these crashes and every other crash in human history is that they're temporary. They simply reflect short-term investor panic. And occasionally, the price of wonderful businesses become really attractive. It's in these moments that all of Buffett's rules and principles come together. If you stick to your unique competencies and find the rare wonderful businesses generating high and sustainable returns on capital that are run by talented and honest people, you have an idea of what they're worth and only plan to buy them when they're far below value to prevent permanent loss of capital, then it's in these moments of market pessimism where you'll be able to make investments that you'll hold for decades. Hit subscribe to stay up to date with the content that I'll be producing directly from the Berkshire Hathaway shareholder meeting, and check out some of these videos next.